90% rejected. That's the number that caught my attention. 90% of junk silver, sterling, and alloy silver is currently being turned away by refineries. Not because the metal isn't valuable, not because demand is low, but because the refining infrastructure can't handle it. And while everyone's watching silver prices climb past $38 per ounce, I keep asking myself one question. If refineries won't accept the metal, if dealer capital is tied up in unsellable inventory, if the system that converts raw silver into tradable forms is breaking down, what happens when real demand hits? My theory is this. We're watching the early stages of a physical silver crisis that has nothing to do with mining and everything to do with infrastructure collapse. And the pattern I've been studying suggests this isn't a temporary bottleneck, it's a structural break. Let me show you why. I'm not a financial advisor. This isn't financial advice. This is pattern recognition based on refinery capacity data, dealer reports, and historical precedent. And what I found suggests the silver market is fragmenting into two separate systems: paper silver that trades freely, and physical silver that's increasingly locked in forms that can't be processed. When those two systems diverge far enough, something breaks, and we're closer to that breaking point than most people realize. Let me give you the framework first, because this pattern has played out before in commodity markets. 4 stages, always. Stage 1 is normal operations. Refineries accept all forms of metal. Processing capacity exceeds supply. Premiums are minimal. The system functions smoothly. Dealers can buy junk silver, send it to refineries, and receive standard bars or rounds that trade at spot price. The infrastructure works. Stage 1 is stability. Stage 2 is capacity constraints. Demand increases. Refinery throughput hits limits. Processing times extend. But the system still functions. Dealers might wait longer, but eventually, material gets processed. Premiums start rising slightly because supply is tight, but it's manageable. Stage 2 is when stress appears but hasn't broken anything yet. Stage 3 is rejection crisis. Refineries can't handle the volume. They start refusing certain forms entirely. Junk silver, sterling, industrial scrap, anything that requires additional processing gets turned away. Dealers are stuck holding inventory they can't convert. Capital gets tied up, cash flow problems emerge, and premiums on accepted forms explode because the only silver trading freely is what refineries will process. Stage 3 is when the infrastructure breaks down while demand is still rising. This is where we are right now. Stage 4 is system dislocation. The gap between paper silver prices and physical availability becomes so extreme that the market splits. Futures trade at one price. Physical silver trades at massive premiums, if you can find it at all. Dealers stop selling because they can't source inventory. Refineries are backlogged for months, and the people holding physical silver realize they're sitting on an asset that's worth far more than the spot price suggests. Stage 4 is when the infrastructure collapse creates a price crisis, and we're at the door. Now let me prove this pattern to you using historical examples, and then I'll show you why 2026 is different and potentially worse. Example 1. 1980. The Hunt brothers silver squeeze. They accumulated 200 million ounces, took delivery, drained refinery capacity. At the peak, refineries couldn't keep up with delivery demands. Wait times extended to months, premiums spiked. And when the squeeze broke, not because supply increased, but because exchanges changed the rules, the infrastructure was revealed to be far more fragile than anyone understood. The refineries weren't built for that kind of demand surge, and the system nearly collapsed. The lesson? Refinery capacity is the hidden bottleneck. When demand exceeds processing ability, the physical market decouples from paper prices. Example 2. 2011. Silver hit $49 per ounce, But here's what most people don't remember. You couldn't buy it at $49. Dealers were sold out. Mints had 6-month wait lists, and premiums on available silver were $8 to $10 over spot. So the price was $49. But if you actually wanted physical metal, you were paying $57 to $59. Why? Because refinery and mint capacity couldn't meet demand. The paper price said one thing, the physical market said something else, and the people who understood that gap made fortunes buying physical early and selling into the premium spike. Example 3, 2020, COVID panic. Silver spot dropped to $12 in March 2020, but physical silver coins were selling for $25 to $28. Dealers couldn't source inventory. Refineries were shut down or operating at reduced capacity, and the disconnect between paper and physical was so extreme that it broke the illusion that spot price reflects actual availability. That was a temporary shock. Refineries came back online, supply normalized, but it revealed the fragility. And now, in 2026, we're seeing that fragility become structural, not temporary. 3 examples, same pattern. Refinery capacity is the hidden constraint. When demand surges or capacity shrinks, the physical market decouples, and the people holding physical metal benefit massively, while paper traders are stuck with contracts that can't be converted to metal. Now let me show you what's happening right now, and why I think we're in stage 3 heading towards stage 4. First, the rejection crisis. According to dealer reports, 90% of junk silver and sterling submissions are being rejected by major refineries. Why? Because processing alloy silver requires additional steps: melting, assaying, refining to 0.999 purity. It's time-intensive, it's expensive, and refineries are prioritizing higher margin work, like processing doré from mines, or refining large institutional deliveries. They don't want small lots of mixed purity material. So dealers are stuck. They bought junk silver at 20x to 22x face value. They're holding it, but they can't convert it to standard forms that trade at spot. Their capital is locked. And if this continues, some dealers will face cash flow crises that force them to stop buying entirely. Second, the capital trap. Here's the mechanism. A dealer buys $100,000 worth of junk silver from the public. Normally, they send it to a refinery, receive 0.999 bars, and sell those at spot plus a small premium. Turnover is quick, capital circulates. But now, refineries won't accept it. That $100,000 is sitting in a vault, generating no return, and the dealer can't buy more inventory because their capital is tied up. Multiply this across hundreds of dealers, and you're talking about tens of millions of dollars in locked capital. That reduces liquidity in the physical market. And reduced liquidity means higher premiums on available forms. Third, premium explosion on accepted forms. If refineries won't process junk silver, but they will process mine output and large bars, then the only silver available for retail purchase is what comes directly from mints or existing inventory. And that inventory is limited. According to market data, premiums on American Silver Eagles are currently $5 to $7 over spot. That's roughly 15 to 18% premium. Historically, premiums are $2 to $3. The premium explosion is a direct result of refinery constraints limiting supply of processed silver. Fourth, the paper versus physical divergence. Futures contracts trade at $38 per ounce, but if you walk into a dealer and try to buy physical silver, you're paying $43 to $45. That's a 13 to 18% gap. And here's the critical question: which price is real? The paper price that you can't actually access because physical isn't available at that level, or the physical price that reflects actual supply constraints? The answer is obvious. The physical price is real. The paper price is an abstraction. And the wider that gap gets, the more unstable the system becomes. Now let me connect this to the production deficit narrative, because this is where it gets interesting. Silver has been in a production deficit for multiple years. Mining output plus recycling is less than industrial and investment demand. According to Silver Institute data, the deficit in 2024 was approximately 148 million ounces. In 2025, projections suggest 117 million ounces. That's real. That's structural. But here's what people miss. A production deficit doesn't mean there's no silver available. It means above-ground stockpiles are being drawn down. And as long as those stockpiles exist, the market doesn't experience acute shortages. It experiences rising prices and tightening premiums. The refinery crisis is different. The refinery crisis means even though silver exists, it can't be converted into forms that trade freely. That's a bottleneck. And bottlenecks create price dislocations far more extreme than production deficits. Here's the mechanism that terrifies me. Imagine a scenario where industrial users need silver for solar panels, electronics, medical devices. They go to suppliers. Suppliers go to refineries. Refineries say, "We're backlogged. 6-month wait." The industrial user can't wait 6 months. Production lines need material now. So they pay premiums, massive premiums, $50 per ounce, $60, whatever it takes. And suddenly, the spot price of $38 is irrelevant because the real clearing price for physical delivery is far higher. That's stage 4 dislocation. And the refinery rejection crisis is pushing us toward that scenario. Now let me talk about the investment decision framework, because this is where understanding the pattern matters. If you have $2,500 to allocate, should you buy gold or silver? Let's run the numbers. Gold at $3,500 per ounce. With that budget, you get 0.71 ounces of gold. Silver at $38 per ounce, plus premium, call it $43. You get approximately 58 ounces of silver. Now, let's say both metals appreciate 30% from here. Your gold position is worth $3,250. Your silver position is worth $3,350. Similar returns. But here's the additional factor. The gold to silver ratio is currently around 92-1. The historical average is closer to 60-1. If that ratio normalizes, silver outperforms significantly. A 30% move in gold could coincide with a 60% to 80% move in silver just from ratio reversion. That's the mathematical setup. Silver offers more upside if the ratio corrects, but it's also more volatile. More risk, more potential reward. Now let me introduce a third option that nobody's talking about. Pre-1933 US gold coins. These are $20 St. Gaudens, $10 Indians, $5 half eagles. They contain roughly 1 ounce, half ounce, or quarter ounce of gold respectively. But here's why they're interesting. Premiums on pre-33 gold are lower than modern bullion. A St. Gaudens might trade at 5 to 8% over melt value. A gold eagle trades at 3 to 5% over spot, but you're paying $3,500 plus per coin. With pre-33, you get gold content, you get lower premium, and you get numismatic upside. If gold continues rising and collector demand increases, pre-33 coins can appreciate faster than bullion because they're finite. They're not being minted anymore. Many have been melted, and the remaining population is shrinking. That's a supply constraint independent of gold's spot price. So you're getting gold exposure plus scarcity premium plus historical value. For a $2,500 budget, you might consider a mix. One pre-33 gold coin for stability and numismatic upside. Then allocate remaining capital to silver for leverage and ratio play. Here's the positioning framework I use. Not advice, just how I think about structure. 40% gold for stability. Pre-33 coins if possible, or bullion if premiums are better. 60% silver for upside. Focus on recognizable forms. American silver eagles, Canadian maples, or standard .999 bars from major refineries. Avoid junk silver right now unless you're getting significant discounts, because the refinery rejection crisis means you might not be able to convert it easily. And here's the critical rule: never clean coins. Ever. If a coin has numismatic value, cleaning destroys it. 60 to 70% value loss just from cleaning. Even if it looks dirty, even if you think it would look better shiny, don't touch it. Numismatic value comes from originality. Cleaning removes original surfaces. Collectors will pay premiums for untouched coins. They won't pay anything for cleaned ones. When in doubt, leave it alone. Now let me show you the war scenario, because this connects to why silver could spike far beyond current levels. The video asks if silver could reach $120. My answer? Not from normal market forces, but from abnormal events? Absolutely. Here's the mechanism: geopolitical conflict. Let's say a major war breaks out. Energy prices surge, inflation spikes, currency trust collapses, investors flee to hard assets, gold and silver. But here's the additional layer. Modern warfare requires silver. Missiles, drones, radar systems all use silver for conductivity. If a conflict escalates, military demand for silver could create supply shocks independent of investment demand. And if that military demand coincides with investment panic buying and refinery capacity is already constrained, you get a perfect storm. Spot price could gap from $38 to $60 to $80 in weeks. Not because of fundamentals, because of panic and supply constraints. And if the refinery crisis persists, physical premiums could add another $20 to $40 on top of spot. So yes, $120 silver is possible. Not likely in normal conditions, but entirely plausible in a geopolitical crisis scenario where multiple demand drivers converge simultaneously. Here's the data that keeps me up at night. Global silver inventories on exchanges are down approximately 60% over the last 4 years. COMEX registered silver, the amount available for delivery, is under 60 million ounces. That's less than 3 weeks of global consumption. And now refineries are rejecting 90% of junk silver. So the visible, tradable inventory is shrinking, while demand from solar, EVs, and industrial applications continues growing. That's not a recipe for stability. That's a setup for a squeeze. And the people positioned in physical silver before the squeeze hits will benefit. The people trying to buy during the squeeze will pay extreme premiums or won't find metal at all. Now let me walk through the timeline scenario. Not prediction, pattern recognition. 2026, refinery rejection crisis continues. Dealer capital remains tied up. Premiums stay elevated. Silver grinds higher, testing $42 to $45. This is late stage 3. 2027. A catalyst emerges. Industrial shortage. Geopolitical event. Investment surge. Whatever it is, it accelerates physical demand while refinery capacity remains constrained. Premiums explode to $10, $15, $20 over spot. Spot itself gaps higher to $55 to $65. This is early stage 4. 2028. If the catalyst intensifies, if refineries can't expand capacity fast enough, if military or industrial demand spikes, silver could test $80 to $100. And physical premiums could push real prices to $120 plus for anyone trying to source material quickly. Again, not guaranteed, but the structure is there. The refinery bottleneck, the production deficit, the inventory drawdown, all the pieces for a major dislocation. Here's the question I can't answer. Will refineries expand capacity? Can they expand fast enough? Or is the infrastructure constraint permanent at current price levels? If they expand, the crisis eases, premiums normalize, the squeeze dissipates. But if they don't, if capital allocation and environmental permitting and equipment lead times prevent rapid expansion, then the bottleneck becomes structural. And structural bottlenecks create long-term price dislocations. That's the variable I'm watching: refinery capacity announcements. If major refineries say they're building new facilities or expanding throughput, that's bullish for supply and bearish for premium explosions. If they stay silent, it means the constraint persists, and that's bullish for physical holders. Here's what I'm not saying. I'm not saying silver goes to $120 tomorrow. I'm not saying refineries collapse next week. I'm not saying you should sell everything and buy silver. What I'm saying is the market structure is showing fragility. 90% rejection rate is not normal. That's a crisis. And crises create opportunities for those who see them early, and risks for those who don't. If you're holding physical silver, you're positioned. If you're holding paper contracts and the refinery crisis deepens, you might find out those contracts are harder to convert to physical than you assumed. And that gap between what you think you own and what you can actually access, that's where wealth transfers happen. Let me show you one final historical parallel. 1979. Silver was $6 per ounce. The Hunt brothers started accumulating. By January 1980, silver hit $49. The people who saw the pattern early and bought physical silver at $6, $8, $10 made fortunes. The people who waited until $30 still did well. The people who bought at $45 got crushed. The lesson? Position early, not at the top. Right now, silver at $38 with refinery constraints and production deficits and geopolitical risk, that might be early. Or it might be mid-cycle. But it's definitely not late. Late is when retail FOMO dominates, when everyone you know is talking about silver, when premiums are $30 over spot and dealers are sold out. We're not there yet, and that means there's still time, but the window is narrowing. Here's the positioning principle. Recognize the pattern, reduce fragility, hold forms that trade freely, avoid cleaning coins, understand the gold-silver ratio, consider pre-33 gold for stability, and be patient. This isn't a quick trade. This is a structural shift that takes years to play out. The refinery crisis is real. The production deficit is real. The inventory drawdown is real. And the gap between paper prices and physical availability is widening. Those are facts. How fast it accelerates, that's the variable. But the direction is clear. So here's my question. Do you see the refinery crisis? Do you see dealer capital locked up? Do you see premiums exploding on available forms? Because if you do, you understand. This isn't about silver going up. This is about infrastructure breaking down while demand is rising. And when infrastructure breaks, price dislocations follow. The people who see it early position. The people who don't wonder why they can't buy silver at spot. And by the time they figure it out, the opportunity is gone. Don't be late. The pattern is clear. The structure is fragile. And the clock is ticking. If you want to follow this as it unfolds, subscribe. Because the refinery crisis is just beginning. The premium data, the rejection rates, the dealer reports, all of it is developing in real time. And understanding where we are in the pattern, stage 3 moving towards stage 4, that knowledge matters. The people who position before dislocation benefit. The people who chase after the spike pay extreme prices. The choice is yours. But the window won't stay open forever.